You're welcome back. Now let's look at measurement of equity settled share-based payment transactions. The issue here is, how do we measure the cost of the goods and services received and the equity instruments, be it shares or share options, granted in return? How do we measure them? Really, that is the challenge. The general principle in IFRS 2 is that when an entity recognizes the goods or services received and the corresponding increase in equity, it should measure this at the fair value. The fair value of the goods or services obtained by an entity should be measured directly. Okay, just look at what's the value of these goods. Then you use that to measure the share-based payment transaction, or you look at, can I place a value on this service? Okay, that's measuring it directly based on the goods or service received. However, if this cannot be measured reliably, then the entity should measure the value of the goods and services by reference to the fair value of the equity instruments granted as consideration. This is sometimes referred to as the indirect method, and in these circumstances, the fair value of the equity instruments represents the best substitute for the price of the goods and services. Where the transaction is with the entity's employees, for example, entities often grant shares and share options to employees as part of their remuneration package, in addition to a cash salary and other remuneration benefits. The share and share options component of the remuneration package is the equity settled share-based payment transaction. What we are saying is that if it is not possible to measure directly the services received from the employee, really, how do you want to measure the service you are receiving from the employee? Okay, the employee works today. Now, how can you place a value on that? Okay, really. So in such cases, the employee service will be measured by reference to the fair value of the equity instrument that is granted. So the fair value of those equity instruments should be measured at the grant date, the date you gave the employee the share option. Where a transaction is measured by reference to the fair value of the equity instruments granted, the fair value is based on market price if available, taking into account the terms and conditions upon which those equity instruments were granted. If market prices are not available, the entity should estimate the fair value of the equity instrument granted using a valuation technique. This is beyond the scope of your exam. However, where the transaction is with a party other than an employee, then it is presumed that the fair value of the goods or services can be measured reliably, which is true. If a supplier offers you goods and you are given equity instruments, of course you know the value of the goods you have received from the supplier because it will surely give you an invoice. Okay? However, in rare cases, if it is not possible to measure it directly, then the fair value should be measured indirectly by reference to the fair value of the equity instruments granted as consideration. Okay? And I'm sure you remember that a grant of equity instrument is often conditional upon satisfying vesting conditions. Okay? I'm sure you remember that. Now, what we will do is that we will look at how to calculate the expense each year for a share-based payment transaction, specifically equity settled share-based payment transaction. Then you will see the steps we will follow to determine it. Let's do that in the next video by looking at an example. See you.